Welcome to our Sales Tax Agony webinar. I'm Bianca from Paddle. Nice to see some familiar faces here in the audience today. Just some housekeeping notes from me before we start. The webinar is being recorded and the slides will be shared on email after the event, so look for that next week. Really happy to have Hugo and Rachel here today with us. They're our in-house tax experts, and I'm super pleased to have them on board today to share their do's and don'ts of sales tax. Rachel, would you like to introduce yourself to our audience here?
I joined Paddle just over a year ago, and I very much had a baptism of fire into the world of sales tax, because I joined at the point that we then were registering with all of the US states and having to start reporting all of that. So my job was immediately very heavily focused on a very large amount of laws and regulations and calculations and remittance. So that was super fun. Yeah, and since I started, we've kind of registered with a number of new countries, and kind of constantly monitoring new countries that are being kind of added as well. So there's still an element of kind of constant monitoring and research involved.
Now I'd like to hand it over to our second speaker, Hugo. Hugo is the CFO of Paddle. He's been with Paddle forever. He's our in-house tax expert and finance guru. So I'm super pleased to have him today.
Hi, Bianca. Thank you very much. So yeah, a little bit about me. I've been at Paddle for almost the entire journey of the company. So I joined 6.5 years ago when there were kind of 8 people. I was the kind of first finance person to come on board. And I've really kind of become an expert in international sales tax by accident, because if you told me back in 2014 when I joined that we'd end up being registered in tens of jurisdictions, 65 or whatever it is, I probably wouldn't have embarked on my journey through Paddle. But anyway, when I joined, it was just one filing through the UK for all EU sales, and it was very simple because it was effectively, you just charge VAT to all customers at the UK rate, and it was all very simple. And then a kind of VAT MOSS came along shortly after I joined, which was kind of implemented on 1st of January 2015. And since then, there has been a kind of explosion in sales tax that we're going to talk about today. And with the team that I built over the years, we just make sure that we are on top of compliance and filing and registration and all of that good stuff. And we are probably the most compliant company out there. Yeah, and this kind of webinar is really to talk about how it came about and what the kind of pitfalls are. Perfect. So just before we start, very briefly on Paddle. So just these are a few of our SaaS customers. We work with thousands of SaaS businesses, and we talk to many more. And the pain of the ever-expanding tax landscape and globally is kind of real, and it's something that our customers feel very keenly. I mean, the fantastic thing about software is that you can be global from day one. There are no borders on the internet. Unfortunately, kind of tax jurisdictions have not kind of bought into that concept. So you can end up triggering some quite complex kind of registration requirements, which if you don't kind of catch in time can lead to some liabilities down the line. Yeah, and what Paddle does is that we are a software reseller. So we contract with the owner of the software or SaaS product, and then we sell to the end customer. So because we're making that sale, we are liable for sales tax on that sale. Yeah, we're registered in 59 jurisdictions. I think we have 12 in the pipeline in the next kind of 18 months. And we've got an in-house team, including Rachel, who manage the entire process end to end, which is kind of covers scoping out new jurisdictions when they're about to come live, and then it's registering, filing remittance, and then sending the cash to the tax jurisdiction, wherever that is in the globe. And then there's also added to that kind of some of that, which is a manual process. There's a load of automation that we built in the background to ensure that we can file in the most efficient way possible. Great, so that's on Paddle, and then I'm going to move on to this next slide. So we at Paddle kind of built this what we call Tax Agony Index. So it's kind of aimed at SaaS businesses, and what it allows you to do is kind of provides a database of where a software business might be liable for sales tax, but also kind of you can see the kind of the chili on the left there. We kind of rank jurisdictions by the pain. So the higher number of chilies, the hotter or more painful the jurisdiction is. And then there's a little calculator. You can see the GIF there. You can put in what your MRR is, and it can it spits out what if you were not to be registered anywhere, what we kind of estimate your annual liability might be, and what kind of penalties you might be racking up by not being registered. Then there's a bunch of information there about all the different jurisdictions. I'd encourage you to go and see that. I think Bianca's going to share a link to that in the chat. Awesome. So moving on to this map here. So I mentioned that when I joined Paddle, it was kind of pre-VatMoss. I mean, just taking a little step back and talking about why it is that this has become such an international kind of issue now, and there were some jurisdictions that kind of came online for international sales tax for digital businesses, but it was really the EU that kind of catalyzed the kind of explosion. So, and it's basically we've got mainly kind of Google, Apple, Amazon to blame, because when they set up in the EU, the rules were that you charged sales tax at the rate of the country that you registered in, and all the kind of cash from that came into that country. So the clever tax advisors that they had basically said you should all sign up in Liechtenstein or Luxembourg, because there the tax rate is only 15% versus about 20% for the rest of the jurisdictions. So the end consumer pays less VAT, everyone's a winner. The bigger nations in Europe kind of took a dim view to that. So they then introduced this concept of VatMoss. So it flipped the kind of whole transaction flow on its head and said, instead of the seller location being the place that determines the sales tax that will be charged to the end customer, it is where the end customer is located. So that meant there was no advantage to setting up in Luxembourg as a kind of business, and B, the end consumers were charged the correct amount of VAT, and more importantly for the kind of the bigger countries is that they got more share of tax revenue. So that was rolled out in 2015. It was a great success, and actually, to their credit, normally kind of tax-related or government-related kind of tech initiatives are terrible. The VatMoss system actually works pretty well, and it kind of got a lot of other people thinking about doing the same thing. So kind of rolling forward, there were a bunch of jurisdictions. So 2016, 17, and 18, there were a few more jurisdictions added. So you can see 2017 was quite a big year. So Russia, India, Australia. Then 2018 was the kind of another big year. So you got some people in the Middle East there. So you got Saudi and I think the UAE as well, Argentina. But obviously the big one there is the US. So you may be familiar with the Supreme Court case between Wayfair, so a tech company, and the state of South Dakota. Effectively, there was no change in the law, but what this Supreme Court case meant is that a state, and it was adopted by many states, but a state can utilize what's known as economic nexus when determining taxability in state versus physical nexus, so actually having a physical presence in the state. So suddenly, and this changed overnight. Normally these things are well telegraphed. You've got 2 years to work to kind of prepare for them. This was basically overnight. The law the interpretation of the law changed, and suddenly a lot of companies that were selling not a huge amount of volume into these states were suddenly liable for tax. And I think Rachel's going to talk about some of the complexities and how you register, but effectively it's either a monetary value or a number of transactions, and for most of the states, it's 100 or 200 transactions actually trigger a tax liability, which is crazy. But it's just the way it is. And the US takes a very dim view of non-compliance, and we can kind of talk about that a bit later. So following that, we'll roll forward to 2019 and 2020, and where we are, in the kind of other jurisdictions which are thinking about this. But you can see that it's a pretty global phenomenon now, and anyone who has a significant portion of digital products being sold in their country will eventually adopt this. So it's not a problem that's going away. It's a problem that's getting bigger and bigger, and quite a lot of these jurisdictions don't have a big threshold for sales. So it might be tens of thousands of dollars of sales. It may be $100,000 of sales into a jurisdiction, but for particularly for Europe or the US, that you get through that pretty damn quickly. Cool. So on the next slide, we're going to talk about a fictional company, and just to kind of make this a little bit more real, but what we think that this would imply for that company. So Scully Limited, we got here as a SaaS business. It's growing fast. It's got to ARR of $5 million. So a decent size, kind of still, I'd say, kind of probably SME or medium-sized kind of software business. And in terms of its customer base, it's B2B, but it's also selling to individuals, so kind of what we call kind of prosumers, so people who are not in businesses themselves, or are not sales tax registered. So they're kind of caught by the kind of broader sales tax net, which is primarily B2C, but it's also B2B. And we've assumed that, based on our experience of dealing with lots of software customers over the years, the majority of their revenue is in the US and the EU. So, let's say 75% of their revenue is in US and EU, and about 25% in the rest of the world. So if we move on to the next slide. Cool. The kind of pain points from a sales tax perspective, as we see them, it'd be great if people have different views, but around kind of registration, so getting up and running in a jurisdiction, and then there's filing and remittance. So that's the kind of number one is setup, number two is kind of ongoing management, and then finally kind of penalties, which is a kind of consequence of not having registered on time. And then if we're looking at Scully here, there's a few kind of assumptions we made, and I'll kind of cover these off in a high level, and Rachel will kind of discuss them in a little bit more detail. But per our estimates, with that, the level of revenue that they have, say $5 million a year, if they wanted to be fully compliant, we think that they would need to be registered in at least, or about, 30 US states, where they would basically trigger the minimum number of transactions. So that's 30 different registrations, just to be clear. And they would also need to be registered for VAT in the EU, which would be one main registration, and then they're kind of using the VAT MOSS system. And then there's a few other jurisdictions they would be caught by. So, once again, this is based on a bunch of assumptions, but we think that they would probably need to charge sales tax in Quebec, in Canada, in Australia, Japan, India, and Russia. And they'd be pretty close to the Swiss threshold as well. And then, once we've got this sort of slider here, if they weren't registered, then the kind of sales tax liability that they would be accruing annually would be around, it's a big range here, but let's say around $500,000. And you can see that there's some quite significant penalties on that as well. And on that note, I will hand over to Rachel, who will take you through some of these jurisdictions in a bit more detail.
Thank you, Hugo. Okay, so with registration, obviously this is the first step in the process, but before you can actually register, there's a lot of research you have to do. You have to be kind of looking for the relevant criteria or the thresholds that some countries apply that determine whether you have to register or not. Some countries have no threshold at all. So as soon as you make your first sale, you're liable to report that tax and pay for it. And others, until you hit, $100,000 worth of sales within 12 years, you don't have to report it and you don't have to be charging tax. You have to be very careful with the research you do online, as there's a fair amount of conflicting information, either from there's so many different kind of tax websites, tax experts that are maybe they're looking at it from a different perspective, or they wrote the article in 2018 and the law is changing and evolving constantly, that article is actually no longer relevant. Some countries themselves produce and provide really helpful guides and information about how to register, whereas other countries, by the time that they say you have to register, they're still in the process of setting up the website that allows you to register, so you have to do it all yourself. So we've picked a few to focus on. So we're going to talk about the US, EU, and Japan. So with the US, as Hugo mentioned earlier, the Wayfair case has, definitely propelled the US into the forefront for a lot of tax departments. The amount of research required for the US is absolutely huge, because it's likely that you're selling into multiple states, not just one, and the thresholds and the conditions vary across each state. And there are, along with the state, there are also certain extra jurisdictions that you might have to register with as well. So even if you're selling into Colorado, you might also have to register with Denver separately, because they have their own jurisdiction set up. US is also odd in that it's still a very paper-based process. You'll have online accounts once you register, but the US seem to really, really love people sending posts and then them sending posts back to you. The tax permits that they send will always be posted. The majority of the correspondence or any updates to tax rates, they want to mail them to you, which is a bit annoying as well, but just thought I'd throw that in. So I suppose if we kind of come back to the kind of example company we have with Scully, if we say, maybe they've reached the threshold that means they have to register in about, 20 US states, I'd say it would take, at least, about 5 hours per state to put the data together, complete the registration process. So that alone is about 100 hours of work just for registering, and assuming that it's all approved and there are no, hiccups along the way, which, there are sometimes. Okay, so moving on to the EU. So we've got the VAT MOSS system that was introduced in 2015. So you can register and pay VAT to HMRC rather than having to register and pay VAT individually to each of the 27 member states, although you still have to account for the varying tax rates across each country. So it's something you have to be quite careful about. And they also have two types of kind of registrations or schemes, union and non-union, depending on if you're a UK or EU based company or you're outside of the EU. The sales threshold for whether you need to register is kind of is for your collective sales across all of the countries. And given that the threshold is quite low, it's not going to take very long to to make you required to register for this scheme. Although if you are a company based outside of the EU, there is no sales threshold at all. So as soon as you make a sale into the EU, you have to report it. And I suppose there's also, with the upcoming impact of Brexit, this will also be affected. For UK businesses, I think the last VAT MOSS return you can file just as normally as you've been doing will be, for the period ending December 2020. After that, UK businesses will have to register for the non-union scheme, but you can't even do that until 2021. So they're not letting anyone do advanced registrations. And then businesses that are already in the non-union scheme have to take all of the UK sales out of their returns, and then they'll have to register for UK VAT and report their UK sales that way. So I'm sure we are all very much looking forward to that, because we all know it's going to be fun. Okay, and then moving on to Japan. So we've included this one because it's an example of a territory where you can't register, file, and pay the taxes yourself, because Japan requires the use of a tax representative. For, let's say for Scully, they would have to do the research themselves and source a reputable tax agent, which it can be a very, very slow process, and the fees can also be quite expensive, and the fees tend to increase in line with the level of your sales. So the more sales you make, odds are the fees that the representative charges you will increase as well. And the requirements for registering with Japan are incredibly strict, and you have to be able to show proof of who you are, what your company does, how your company does it. And at Paddle, when we were registering, we actually shared a sales demo video, just as a way of proving that we were a legitimate company. Okay, so now we'll move on to the filing and remittance aspect. So the rules and processes vary massively depending on the territory you're dealing with. The way tax is calculated is different. The information that you have to provide and the frequency that you have to file. So just to keep it consistent, we're going to look again at the US, EU, and Japan. With the US, I'd say it makes sense almost to treat each state as if it's a completely separate territory or country, because the way that you have to process it, there isn't really a flat approach you can adopt to all of it. There are some states that are so nice and simple, and they have one single flat tax rate that you can apply to all your sales, and then all you have to do when you file is say, this is my level of sales, and that's it, and they're wonderful, and we love those. There are other states where it's so much more involved. They have the state tax imposed, and then they also have a county tax rate, they'll have a city tax rate, and then they'll also have kind of special tax rates just for particular districts or particular buildings that are worthy of their own tax rate, just because they really want to keep you on your toes. And then also, when you are reporting these, you have to split out your sales across all of these different jurisdictions. So you have to make sure that the information you're collecting is accurate, the street address or the zip code, because the tax rates can literally change from one street to the next. And it can take a really long time just breaking this information down and putting it together so that you can report your sales for the 100 different jurisdictions that you have to separate out. And for somewhere like Texas, which was initially the bane of my life, they have, you know, about 1,700 jurisdictions, and you have to manually input your sales for each of these jurisdictions. And if you don't do it, you know, if you don't do it quickly enough, the website also times out, at which point you have to start again. So yeah, Texas is just the worst. There are a couple of states that you can apply to use a flat rate rather than actually adopting the specific rates. So that can have that can save a lot of time. It also makes the whole process a lot easier. Some states also, they'll provide files and templates that you can use to upload it rather than having to enter in anything manually. But then you also have to just be very careful that your data is accurate, and you'll usually have to split the sales out from what was deemed exempt, what's taxable, what credits did you apply, and also the filing frequency for a lot of the states. They will change based on your level of sales. So the more sales you start making, the more frequent you have to file as well. So it's constantly having to monitor it, as there are constant like slight tweaks to tax rates as well. You know, one small town will say they've decided to change their tax rate, and you either have to try and research and be aware of this yourself, or wait until you get the letter in the post from the tax office to let you know that this changed. So it's just a constant monitoring, and it's the US is a very it's a very, very big job, and it's you definitely need patience and I think support when you do that. Okay, so moving on to the EU. So there's two ways that you file your sales in the EU. You've got the VAT MOSS scheme, and then you've got the EC sales list, which are both done quarterly. The VAT MOSS scheme is for where you report your B2C sales to just your individual consumers. As I said before, you have to be careful that you're charging, you know, the correct tax rates, and you also have to be aware of any temporary changes they make to the tax rates. So recently, Germany decided to reduce their tax rate from 19% to 16% for a 6-month period, and that can affect, especially when you have, you know, transactions relating to a prior period that were 19% when you're reporting it in a period where it has to be 16%. You have to be very careful about that. And then they also have the EC sales list, which is where you report your B2B sales, so the sales that you've made to VAT registered businesses. And this is all filed online. But with that process, you have to make sure you've collected obviously all of the VAT numbers, and then the corresponding you know, location, the country of the buyer. You have to make sure they're formatted correctly, and then you have to do a manual verification of all of those VAT numbers to ensure that they're valid. And it might only be at the point you're uploading it that you discover there's a number of sales where you approve the VAT number and it turns out it's not valid, which means you can't include it. Okay, and with Japan, so along with it being different because it requires a tax agent, the way that the taxes are filed and paid is also different in Japan to kind of just about everywhere we've dealt with. With Japan, you report the taxes annually. However, you have to make these quarterly interim payments throughout the year. And these are, you know, usually determined by what your liability was in the previous year. And so obviously these payments, you know, will increase year on year as your level of sales increase. But these interim payments, it makes the, the quarter end and the year end reconciliations more difficult, because these payments aren't based on the level of your actual sales for that quarter. And then obviously you have to take into account the fees that you'll have to pay each quarter with these payments to the tax agent as well. Okay, so now we're going to hand back over to Hugo so he can talk to you about the scary and serious side of penalties.
Rachel, I must say I don't envy you dealing with Texas. It sounds pretty horrendous. So in terms of penalties, clearly these will vary from jurisdiction to jurisdiction, but in general they kind of follow a theme. So first one is kind of back taxes. Effectively, if you have not been charging sales tax where you should have been charging sales tax, then the jurisdiction will make you, once you've registered, kind of pay that all back. Once again, it may be time limited. So in the US, there is a process called the VDA, a kind of voluntary disclosure agreement, whereby you can kind of cap the liability at 3 years worth of sales, which I guess is about the only good thing about the US system, because otherwise they are super strict. There are some jurisdictions that might waive it if you've got a good reason, but you shouldn't really count on that. And I guess if technically you can go back to all your customers and get them and reissue them with VAT compliant invoices, and therefore kind of collect the VAT from the end customer and then remit that to the sales to the tax authorities. But unless you're dealing with very large kind of customers or invoices, that is not really practical for most kind of people who are selling a product which is less than about $1,000, I guess, in value. Because if you've got hundreds or thousands or hundreds of thousands of people you need to go to collect payment from, it's just not going to work. And frankly, they're not going to pay you. Interest, so that will tend to be applied at a kind of inflationary rate. So in the UK, it's 3%, kind of based on when they were historically. And then there are fines. Some of these are kind of pretty trivial. Some of them are quite big. Some of them take into account your kind of whether you were aware that you were compliant or not. Some of them are just plain weird. So in the UAE, which was incredibly painful to apply for and set up, their standard charge, I think it's 200 or 300% of the tax liability, and there's no negotiation around that, which is something that we kind of actually discovered to our detriment when we were trying to apply there, and we were pretty much the first people to try and apply in the UAE, and the process was impossible, and we didn't have Arabic speakers, and then we got slapped with a fine, which was not particularly pleasant. Anyway, you live and learn. And then finally, criminal charges, once again, that's sort of a last resort for a tax authority. They're always going to want to settle and get payment, but I think that if you've been willful or fraudulent in your non-disclosure of taxes, then there are obviously potential kind of more serious consequences. But as I say, the tax authorities won't want to do that unless they think that you've done something criminal. And in terms of real life examples of where this has happened, on most people don't don't disclose this, and B, don't have to disclose this when they settle back payments and fines. They just do it behind the scenes. There are a couple of examples from a while back. I remember when Norway Norway had sales tax on digital products for pretty much the longest of any jurisdiction, and there was a German e-commerce company which was relatively well known, that hadn't been registered in Norway and had obviously made a lot of sales, and they were handed a 15 million euro fine or total penalty, which included all of these elements. So you'd obviously have to be doing quite a lot of sales to have that size of liability, but obviously it can mount up to pretty staggering sums, particularly if it's many years of non-compliance. Moving on from the scary stuff. Cool. So I think we're going to do a quick poll of the participants here as to what you're currently using to manage sales tax. And then we'll kind of talk through the results. Hopefully you can access that. Yeah, it'd be great to hear about any stories as well, if you'd like to kind of put that in the chat.
Okay, fantastic. Thanks for your answers. I'm just gonna share the results now on the screen.
Okay, interesting. Okay, cool. So it's got a really pretty even spread actually across the 4 options. I guess for those who aren't yet, it may be that you're too small to need to worry about it. But you know, as I say, if you are, particularly if you're selling into the US, you probably need to start thinking about that sooner rather than later, because that also applies to B2B as well as B2C sales. Yeah, and then I guess if we move on to the next slide, we can talk about the kind of the options that people are can use. So I mean, briefly on this, but the way that we see it, you can effectively do this 3 ways. So if you opted it in-house, hopefully what we've just kind of explained to you demonstrates the complexities and perhaps maybe some complexities that you maybe haven't thought about. It can get very complicated very quickly. I think, particularly if you're on this sort of global sales track and selling into loads of different countries. There is a lot of admin on the kind of filing side, on the registration side, and then obviously there's, which, as Rachel said, in the US, if you're doing 20 states, that is 100 man hours. But then there's all, there's clearly ongoing compliance. And you'll need, at least one headcount who's kind of, dedicated to this. Maybe not 100% at the beginning, but over time, that will probably grow, and it'll probably be multiple people. And then, you can clearly then get audited by any jurisdiction at any time. So that obviously is painful, and will potentially leads to kind of other issues down the line. But it's so it's just it is a bit of a headache. It's doable, but I think that at a certain size, it just doesn't become, it becomes much easier to just outsource that problem, and that's where you get onto the other 2 options. So tax compliance tool, this could also be a kind of an agent in each jurisdiction, but that'd be much more expensive. So there are tax solutions out there that you can buy on the market, and those are quite good for saying what you should be charging your end customers. Sorry. But you will still be responsible for filing and remittance and any audit down the line. You can also use them for, sorry, let's do a copy again. You can also use them for filing and kind of ongoing maintenance, but that can get very expensive very quickly because in the case of the US, there are multiple states. So let's say you get to a certain scale, you're registered in 30 states. Some of them are monthly filing, some of them are quarterly. In the EU, obviously, it's quarterly. In Japan, it's quarterly payments. So there's the ongoing maintenance and filing and making sure that you're collecting the data in a way that you can actually put it into the filings. It can get very complicated. And in terms of the cost of actually using those solutions, for Scully, the example that we brought up, we're doing $5 million a year in sales. We think it's probably in the region of about $4,000 a month in terms of the software cost and the kind of filing costs for all those for the jurisdictions that we mentioned. And then finally, you can use a merchant of record like Paddle. And I guess this is I would say this because I work for the company, but it's obviously very simple. You are selling to the merchant of record or reseller. The reseller is selling to the end customer. There is no sale there's no tax on the sale to Paddle. That's either reverse charge or outside of the scope, depending on where you're based. And the tax liability, all of the requirements, filing, tax, remittance, that is the responsibility of the reseller. So it is obviously by far the simplest solution. And I guess that's sort of one of the reasons that we're talking today, is that we are the tax, we are experts at this. You should, you don't need to be, and you can sell a product like ours. Brilliant. I think we'll now move on to Q&A.
Thanks both. Thanks for that. That was great content. We're already getting tweets in saying like, here's a webinar, how to do this legally. This is exactly what it is. And we've gotten a lot of questions in the presentation. So I thought we could tackle a few of those. First question was, can you talk about the reverse charge for remote sellers into the EU, Japan, etc.?
Cool. Maybe I'll take that first, but once again, I'm not a great expert on that particular thing, because when we are based in the EU, so we think about the reverse charge as a domestic company. But as far as I'm aware, it's a similar process that as a person outside of the EU, you select a kind of jurisdiction as your main jurisdiction, and then anything which is cross-border after that would be subject to the reverse charge. And I believe the finding is the same, but Rachel, correct me if I'm wrong. And in terms of other jurisdictions, it's not called the reverse charge, but there are certain places, Japan being, I think, one of them, Russia is another one, and a number of the other ones, like Australia, for example. Actually, most of the jurisdictions where it's mainly B2C, you can enter a tax number, or the sort of end customer can enter a tax number, and then there will be no sales tax charge. There isn't a kind of a concept of reverse charge, i.e. there's not a filing system in the same way, but you obviously just have to provide evidence to the jurisdiction that no tax should be due on that sale. Rachel, is there anything to add on that?
No, what you said is right. So the only thing to add is the few countries where, rather than it being just B2C, they have B2C and B2B. So every sale is taxable regardless. So kind of countries like Switzerland and Russia and others, where there's no difference between the sales at all.
Great. Thanks for answering that. We're still getting questions, so I'm going to try to get through them as quickly as possible. This is actually a question that we've received in advance as well, so it's a hot topic on people's minds. And Dimitri is asking us, if you're 100% B2B SaaS business with no sales to individuals, the entire team and infrastructure is in the UK, do the same VAT rules apply?
The question to be around, does it apply to B2B, pure B2B SaaS?
Pure B2B,
companies?
exactly, yes.
So if you have no sales to individuals, even if they're kind of business customers, and I guess from a tax perspective, the definition of business is tax registered. It's not necessarily the same as a business normally, but let's assume that you have none of that. Then the jurisdictions that you need to worry about are the US, where they don't distinguish between B2B and B2C. I think Russia, and there's a handful of others. We can probably provide that afterwards, but unless, Rachel, you have a list of those up.
I could very quickly get a list.
Why don't we come back? We can come back to that. We can answer the next question, and then Rachel, you could just talk to that.
Sure. So the next question is from Renata, and she asks, do you have any insights on Latin America tax rules?
Yeah, so there are some jurisdictions that have already gone live with sales tax in Latin America. So on that map that we showed earlier on, I think it's Argentina, Paraguay is coming soon, Colombia, and I think Venezuela, oh no, Ecuador, sorry, are either in process or coming soon. So I guess they're catching up with the rest of the world. Brazil, you'd expect to being probably the biggest economy there, would also kind of jump on the bandwagon. But once again, it sort of depends. Some of them are a little bit slow off the mark, sorry. But eventually, I see most countries doing this.
And it does seem as well for kind of South America, the countries where we've been able to get enough information on, seems as though the majority of them aren't implementing any kind of sales threshold as well. So as soon as they set up a system for an entity to register, as soon as they officially announce that digital services are taxable, odds are you're going to have a sale very soon that means you have to register.
Cool. Thanks for that. The next question is, can Paddle look at all the sales of a client that sells globally and determine for them where they are exposed and need to register?
Yeah. So I guess the Sales Tax Agony Index does that a little bit. But if you'd like to speak to someone at Paddle and kind of get, send some data on where your sales are and how much they are, then yeah, absolutely, we can do that for you.
Great. And I got one more question here sent live that I thought it would be interesting to get the CFO to answer this one. And it says, I run a small SaaS which allows online course creators to easily create an online course individual website. So B2B2C, Paddle doesn't support this sort of business based on emails that I've received. Any chance of that changing?
Yeah, I have to look into that one. But I'm sure that there must be a very good reason why we couldn't support it. But we'll get back to you on that one. If you could follow up with Bianca, and then I'll speak to one of the sales team about why, or maybe the risk team about why we couldn't support that.
Cool. And then Claire asks, have you ever considered running your service for all global sales rather than just SaaS?
Yeah, so I guess Paddle is optimized for, or all of our customers sell software. So if you sell software which isn't SaaS, then we can support that. Or if you sell digital products, we're also set up for that. So, it could be ebooks, webinars, whatever. But we don't support physical goods and that sort of stuff. And, we are hugely focused on software. So that, we've decided to play in this quite narrow niche. I mean, it is a huge market. But so no, there are no plans to service any other businesses for now. That's not to say that won't happen in the future, but it's definitely not on the near-term roadmap.
Thanks for that. I thought we could take some questions that were sent in advance as well by our registrants. So I think we answered this. Do I need to apply for sales tax in the US if my business isn't based there?
Yes, you do. And I guess we sort of covered this off when we were talking about Wayfair versus South Dakota. So yes, technically, if you do 200 sales or 100 sales into a number of states, then you have to register for sales tax in the US. It's particularly if your sales are not very high volume or value, the sales tax liability that will apply to them will be very, very low if it's only 200 sales, i.e. a couple of $1,000s. But yeah, any decent volumes into any state, you should think about it. It doesn't matter where you're located in the world. And as I say, the US takes a pretty militant view towards payment of back tax and interest and fines.
Cool. I think we can do one more and then we'll wrap up. Is it too late to register somewhere I've already been selling into?
No, but there are, every day that you sell uncompliantly effectively, you expose yourself to more liability, right? I guess that's kind of one of the points of this webinar is that ignorance of sales tax in a particular location is not a defense in the tax authorities' mind. They will not accept that. As I say, in the US, they'll you can come to an agreement with them over about 3 years worth of sales, but and there may be some authorities that will be accommodating because of delays and so forth. I mean, like, for example, the Canadian tax authorities have been, with Quebec, because it was new and because they, we kind of telegraphed to them that it was going to take us a while to become compliant because we had to make some product changes. They actually were very accommodating in terms of not charging us a bunch of stuff. But yeah, most jurisdictions that they take a very black and white view towards tax. It's like, you owe us this much money, pay it now.